Good morning, everyone. This is Windsor Brokers Live Daily Market Outlook for Tuesday, 26th of March 2013. New fresh action in the market seen just after opening of European session as Euro came under increased pressure again and basically erased all recovery gains seen from yesterday's low as the Fitch announced further downgrade of Cyprus banks. Cyprus Popular Bank and the Bank of Cyprus were downgraded to D and RD, while Hellenic Bank remains on a negative watch. Fitch rating has taken the actions on the three largest Cypriot banks following the agreement the Eurogroup reached with the Cypriot authorities on Monday morning as precondition to provide the Euro 10 billion financial assistance to Cyprus. As part of the broader weakness of the euro, the single currency hit yesterday fresh 4 months low, pushed mainly by news from Cyprus and the comments of yesterday's comments of Eurogroup's head. His name is Giselle Bloem, who said that the rescue plan for Cyprus, which was, I think we mentioned it in some of the previous session, first of all was precedent, and it was something that happened the first time, but I mentioned, I think that this is going to become a regular plan for the future, and this is what the guy confirmed yesterday. He said that the rescue plan made for Cyprus will serve as a model for dealing with the future banking crisis. This was the yesterday's thunder in the market when the euros slumped after breaking above 130 barrier and holding gains well above this level, dipping as low as 128.40, 128.26, pardon, with this level coming again under pressure this morning as the pair slips again of fresh session high at 128.83. Overall negative outlook still seen on a single currency as the pair broke below its 1 week range floor and being pressured by technicals and the fundamentals, seeing potential for extension lower with the next key support at 126.60 coming into the near-term focus. Of course, more of this we are going to elaborate in our technical part. Just to take a quick look at the currencies, sterling against the dollar again dipped lower following unsuccessful recovery attempt. So far it's still in the positive tone of yesterday's low at 151.42, but the downside risk is still present. However, larger picture is still holding a bullish tone as the pair hit fresh high yesterday at 152.59 and cracked important 152.30 resistance. Dollar yen remains pressured. Brief corrective action seen of yesterday's fresh low at 93.52, still seen limited by 95 on the upside. This is the level that is expected to cap any stronger reversal attempts, while dollar Swiss is firmly up and posting fresh high this morning at 95.03, finally cracking the 95 barrier that was seen as a resistance and the break point for possible retest of the upper targets at 95.50 and 95.65 recent highs. Crude oil remains well supported after posting fresh high yesterday at 95.63 and brief corrective action down to 94, being contained at 94. Fresh strength is now heading higher, 94.60 currently priced for the May crude oil contract, while precious metals remain still under pressure as gold yesterday dipped below psychological 1600 support and reached 1589, basically tested the next support level. Quick recovery up to 1607 was seen immediately after the dip, but pressure remains as near-term technicals are still quite weak on the yellow metal and still see downside risk. Similar with the silver that is currently standing at 128.84. I would say congested at this point under 29 barrier that is seen cupping for now, but overall tone is still negative and requires more work above 29.00 in order to regain the ground and avert immediate downside risk. From today's calendar, we are going to take a quick look. Compared to yesterday when there was no events, today we have some indicators to be released. Realized sales from UK due at 11 o'clock GMT. 12 is forecast, 8 is the previous release. Durable goods orders from United States are at 12:30 GMT. Monthly release 3.8% is seen as forecast for durables compared to minus 4.9 in the previous month release, while core ones are forecasted at 0.7% versus 2.3% in the previous release. The 1300 GMT S&P Case Shiller Composite 20 metro area home price index is forecasted at 7.9, well above previous release at 6.8%. Richmond Fed Manufacturing Index is coming at 1400 GMT. 8 is the forecast compared to 6 of the previous release. At the same time, we have new home sales that are forecasted below the previous release. 437,000 was the previous release. 426,000 is the today's consensus. And finally, consumer confidence from United States at the same time 69.3, slightly below the previous month at 69.6, and that's all from economic indicators. More focus again should be seen on the news and the fundamentals, as lately these became main drivers of the markets, especially the single currency that is quite volatile recently due to the Cypriot problem, and of course the larger picture is showing more impact towards the other, especially peripheral Eurozone countries that are coming under threat. Now we're talking about Spain and Italy that are suffering the same problem like Cyprus. Of course, Cyprus is a smaller country, but damage that has been done is quite big compared to the country's GDP. Sort of solution has been found yesterday, as we spoke already, last minute deal with the Eurozone officials that we believe is going to prevent meltdown and the bankruptcy of Cypriot banks as well as state itself. As we mentioned yesterday, Laiki Bank will go bankrupt, and some of the uninsured deposits will be likely lost, while the other insured ones will be taken by Bank of Cyprus. Of course, the impact is seen much bigger as a number of people will stay without their jobs, as according to the news that were released yesterday. The Cypriot government held a last night meeting to take the measurements, to take the steps, to make measurements and take the steps in order to bring life back to normal. In Cyprus, banks are still closed. The latest news were that will be open today, some of them, except Bank of Cyprus. However, the fresh decision released this morning says that the banks will be open on Thursday, so in 2 days we believe that this is going to be scenario. As said, the euro remains under heavy pressure, as we can see on the 1 hour chart. Recovery rally from last week's higher lows at approximately 129, just above 129, reached 130.47. This was all seen of the recovery, while good signals were given on the break above this congestion of 130.00 on the upside and 128.42 on the downside. Fresh gains, as said, reached 130.47, still short of filling the previous week's gap that required a regain of 130.70, and then fresh weakness came triggered by yesterday's news, erased all the gains and briefly broke below the previous low and range floor at 128.42, 128.26 low seen so far, triggering again fresh weakness and turning the near-term studies back into the negative territory that could have a larger impact on the further weakness, as daily structure remains in the negative territory. Some positive signals were seen on a holding in previous days above the 200 days moving average. Finally, yesterday, day before yesterday's, yesterday's close below this strong support that is currently at approximately 128.70. so far buried the hopes of possible stronger recovery. Basically, the expectations are seen towards the downside as the pair failed to regain some important levels on the upside. We're talking about 130.70 and then peaks of 131.06 and 131.33 required to improve the near-term structure, the signal base, and the open way for some stronger recovery action. So far, again, pressure is more towards the downside, and the most likely scenario will be further extension lower. Again, now a lot depends on the news that will be released, but general negative tone according to the technicals sees the downside firmly in play and favored for now, as the further extension below 128.26, which was the recent low, will threaten test of 128 psychological support, as well as the low of September 30th of September 2012, and then the main targets on the downside, the key supports will come in focus. 126.79 is the 61.8% Fibonacci retracement of the entire 120.42, 137.10 rally, as well as 126.60 higher low of 11th of November 2012, seen as the next target that are now coming in focus as the price action failed on the upside, and the quick reversal lower took out some important support levels that may open way in the near term towards previously mentioned supports. On the upside, again, we have the resistances. Initial one has been tested at approximately 128.80, 90. It comes at 128.80, 90, 129.00, while any improvement requires a break above yesterday's highs at 130.47 and possible regain of 131 barrier to confirm bulls back in play. That is quite unlikely at this point, but again, unpredictable situation regarding the news and fundamentals that are coming one after the other. Sometimes one is positive, one is negative, that we faced basically yesterday on the comments about deal found between Cypriot officials and the Eurozone, and then the cold shower came on the comments of Eurogroup head that said that this model will be used in the future. More focus again, as I say, is seen towards the downside according to the technicals, and the most likely scenario will be fresh weakness down towards 28.00 as the initial target, and a possible extension lower. British pound hit fresh high yesterday at 152.59, better seen on the 4-hour chart. Important at this point is that the previous strong support at 152.30, this is multi-year range floor, has acting previously as a very strong support, and now acting as a strong resistance, has been cracked on the yesterday's rally through 152.30 and the extension up to 152.59. However, corrective pullback is still seen as corrective, as the bull trend line drawn of recent low at 150.26 so far held the downside protected, and still sees possibilities of a possible fresh attempt at 152.59, where we have also above this one of the range lows, previous range lows at 152.67, in order to attract 153, 153.15 upside the targets. However, negative tone that still dominates on the hourly chart, as indicators are still below their midlines, and the RSI is rather neutral at this point, hovering around its 7 days moving average, and standing somewhere in the middle of in the neutral zone, seeing again further sideways movements or more pressure towards the downside. Immediate support is at 150.169, where is the trend line currently standing, while more significant is yesterday's low at 151.42. That also marks 50% retracement of 150.26, 152.59 ascend, and the break below this level could trigger some stronger reversal and keep the upside intact for now. Larger picture structure is still positive, as shown on the 4-hour indicators, despite indicators are in descending mode. Holding above 151.42 will still keep a bullish structure in play, as the 55 days exponential moving average currently at 151.30 so far underpins, but break below 151.42 and 151.32 will risk a deeper reversal, where we'll be looking for test of 151.00. That marks 38.2% Fibonacci retracement of the upleg from 148.30 to 152.59. As said, the 4-hour structure is still positive, and we're still keeping the upside in focus, but we need to see the price being contained above 151.42 in order to keep upside targets in play. Dollar yen lost ground again after completing the bearish pennant that was shown on the hourly chart. We have the shape approximately like this. Break below the lower barrier and break below the previous low at 94.18 has triggered fresh extension through 94 psychological support down to 93.52 that was seen so far. And this also marks over 50% retracement of the recovery rally from 90.85 to 96.70, with the negative outlook seen in the near term, following indicators on both 1 and 4 hour charts holding in the negative territory, and the current bounce higher seen as corrective and being so far capped at 94.45 ahead of 38.2% retracement at 94.51, reinforced by descending 55 days hourly moving average. Any bounce higher will require break above 95 level. This is the previous congestion top in order to improve the structure. Otherwise, more focus still seen towards the downside, and completion of the corrective action will see the fresh bears in action below 93.52, the yesterday's low, is expected to open downside supports at approximately 93 zone. We have 93.08, 61.8% Fibonacci retracement, and then 92, 95th of March low seen as the next downside target. So levels to watch basically on the upside 95.00, on the downside 93.50, and then 93.00. Aussie dollar remains well supported for now, as is attempting again at yesterday's fresh high at 104.78. This morning action ticked above it at 104.79, keeping the upside firmly in focus, though the warning is still seen, despite the price action so far ignores this. I think the warning is still seen on the appearance of the bearish divergence on the RSI and the MACD, as shown on the hourly chart. As we can see that clear divergence is so far, but so far being ignored by price action, as a brief corrective action down to 104.40, where the dips were contained by ascending 55 days moving average, and the positively aligned studies on 1 and the 4 hour chart are still keeping the upside focused, though the overextended conditions not yet overbought on the 4 hour chart again warn of possible hesitation on approach to our next target, psychological resistance at 105.00, above which we will be looking for a test of levels at 105.26, which is 2003 of January high. We have it here, and 105.50 as 105.50 as midpoint for possible full retracement of 105.97 to 101.14. Descent as so far gains retraced nearly 76.4% of entire down leg. Dollar Swiss, just to mention the supports, sorry, I missed to say 104.40, 104.20, and 104.00 as levels to watch on the downside. I think better seen on the hourly chart, and the break below 104 will put the bulls aside and open way for further weakness. Otherwise, upside remains firmly in focus. Again, caution with the bearish divergence that appears, that may cause the hesitation on approach to psychological 105.00 barrier. And finally, dollar Swiss from the majors remains well supported and positive as renewed attempt higher cracks 95.00 barrier. This is also close to 61.8% retracement. I do apologize. It's close to 76.4% retracement of the current corrective pullback from 95.65 peak of 14th of March. That so far dipped at 93.51. This was the low seen yesterday, and the quick recovery higher and break above the recent congestion tops sees now more focus towards the upside as 4-hour indicators now broke into the positive territory, and they're looking for a possible extension and the retest of our upside targets at 95.50 and then 95.51. Hourly structure is quite extended at this point, and some corrective easing cannot be ruled out at this point, though the overall picture is still positive following yesterday's strong rally, and the dips should ideally be contained somewhere around 94.40.50, where we also have the 20.55 moving averages bullish crossover in order to keep the bullish stance in play as we are talking about break above the upside break above the recent congestion following yesterday's failure to sustain losses, to continue losses on the break below the congestion, and despite filling the previous week's gap higher opening by dip to 93.51 that was low seen yesterday, and retracing over 38.2% of the larger 90.20, 96, pardon, 95.65 recovery rally. On the larger picture, we can still see on the daily one that this is seen as a corrective action, as broader action is still being contained by 200 days moving average, and this is quite important and significant to keep focus towards the upside. We had several false breaks lower with yesterday's close, again close above 200 days moving average, keeping a near-term focus still at the upside, the targets at 95.50 and then 95.65. And finally, the commodities and energies, crude oil on the, on the hourly chart remains well supported, though the conditions are quite extended at this point as the price spiked yesterday to fresh high at 95.63. On the larger picture, I think we can see it better even on the daily, retracing over 61.8% on the pullback from 98.63 down to 89.35, and finally breaking above the recent congestion between 92 and 94.45, resuming the recovery from 89.55, 89.55 double bottom, with the daily indicators now building the bullish momentum and breaking above their midlines. That sees again more focus towards the upside as stronger resistance at 95 level, previous range floor, and the strong support has now been cracked on yesterday's break to 95.63, seeing again say more potential towards the upside. Hourly structure, as said, is a bit extended at this point. We might expect some corrective easing. So far, no clear signal of any pullback for now, with the 4-hour indicators being firmly bullish and seeing more room for extension higher, where we'll be looking for a test of 96.00 and then 97.47, which is the high of 97.16 high of 19th of February and 97.47 high of 20th of February 2013, while on the downside 94.45 previous peaks are now offering good support, and the key level again is on the downside at 92, zone break of which will bring bears back to play. That is so far seen unlikely in the near term. And from the commodities, the last is gold. As we can see, the bulls are running out of steam as on the daily chart, as recovery rally from 1554 low of 21st of February 2013 failed to regain important 1620 barrier, also 50% retracement of 1684 to 1554, and subsequent easing now better shown on the lower time frames cracked yesterday 1600 as our reference level and the key support, psychological support also on a dip down to 1590. Swift recovery seen after this was capped at 1607, limited by descending 55 days hourly moving average that maintains downside pressure as hourly indicators are still in the negative territory and lacking momentum for any more significant rally that on the upside requires a break above 1613 and 16 and regain of 1616 previous high of 21st of March in order to bring bulls back in play for possible test of 1620, our key upside barrier. Immediate threat is seen as the 1600 is being tested again for possible extension lower, where we will have 1590 yesterday's low, and then low of 14th of March 2013 at 1576 seen as the next downside target. As set, a negative tone seen on the on hourly chart, and the 4-hour indicators now breaking into the negative territory, seeing more pressure towards the downside as further extension lower would likely trigger a bullish, bearish crossover of 20 below 55 days exponential moving averages that are approaching each other. Now the 55 days one is now in the sideways movements, while 20 days one is reversing and towards the downside, and seeing more pressure towards yesterday's low at 1590 as 1600 is again coming under pressure and being tested for now. And that will be all from my side. I hope I covered everything, but still you can send any question and any comment that you would like to know if you missed to say something. There was a comment about ID. ID you receive with your link for the webinar, and this is handled by other department. But as far as I know, you just you receive it and you just connect, and you should be. I can see you connected here, and I think you can see me, see the screen, and hear my voice. Do we have questions or not? Okay, in this case, if no, we will end today's session. I would like to thank you all for attending our session. I expect, of course, to see you again. We are back tomorrow morning at our regular time at 8 o'clock GMT. A reminder that the time will change on the 30th of March, and we will have you will have it and the GMT plus 3 instead of GMT plus 2, our local time, but GMT time will remain unchanged. Also, the coming Easter holiday and the Good Friday holiday, we will distribute today the holiday schedule, so you will receive it through your trading platform or email. Will be aware some markets will be shut on Friday. We will inform you accordingly. Until tomorrow, I wish you a nice day and a lot of success in your trading. Good luck.